Hi folks, in this video we're going to assess a business in the auto marine parts retail sector. This business does $13 million in revenue with $1.8 million in profit, and we're going to have a look and see where it unravels, because it does. This is this week's episode of Would I Buy This Business? Enjoy. Okay, let's dive into this. First of all, a really nice revenue trend from FY22 up to FY26, just a nice gentle growth trend, 12.2 million in FY22 up to 13.5 in FY26. So this looks like an insanely consistent, healthy business. The gross profit is also so consistent. 39.5% in FY22, some very minor fluctuation of around 1% between 2022 up to 2026. So overall, the fundamentals of this business look incredible. Down to the underlying EBITDA, we have a little bit more fluctuation here, and we won't dive into this too much. And what we've really done here, just because of the level of consistency of the top line and the gross profit, we've just used a 5-year average. You will note that the underlying EBITDA, or the underlying profit of the business in 2022 and 2023 was a little bit lower. So they look like they have made some positive structural changes to the cost base, to the expense base in the last 3 years. So that's a positive. We will, just for the purpose of this exercise, use $1.8 million as the maintainable business earnings, i.e. what will transfer to the owner. And we can pull that apart a lot, I'm certain, and that number may go down, but for the purpose of this exercise, 1.8 will transfer. This, though, is where things start to unravel. This business is so capital intensive from a stock and inventory standpoint. The inventory on hand is $6.4 million. Now that indicates that they have a stock turn rate of 2.1 times. That means effectively they are selling the volume of this stock only twice per year. So they're carrying $6.5 million worth of stock. So that's a real alarm, because the underlying profit itself of 1.8 million is less than a third of just the stock value. So that becomes quite alarming, and we need to look into that further. So the first place that I'm going to look at is what's the closing stock figure on the balance sheet. And this is where things get a little bit more scary again. In the balance sheet, if you guys can see this okay, I'm just going to zoom in on this. Every year, the closing stock figure is nowhere near the amount of stock that they carry. Now, this could be just purely a timing issue. It could be that they are simply ordering stock intermittently throughout the year, and they are running their stock down for 30th of June. However, this just doesn't make sense to me, and it seems very unlikely, because the closing stock figure in FY26 was $1.8 million. That was just 30th of June is it's not even 2 months ago. So how do they have over $6 million of stock on hand just 2 months later? So the first thing I'm going to do is I'm going to check all of the purchasing and make sure that they haven't loaded all of their purchasing, which they may well have done, by the way, but check that they haven't loaded all of their purchasing into the first 2 months of the financial year, because that itself doesn't really make much sense as well. Normally people load all of their purchasing into the last month of their financial year. Anyway, that's something to have a look at. Now, how this can affect things can be significant, because this, to me, is a bit of an indication that the seller has a legacy issue of understating their closing stock figure. And the reason why that impacts everything in the business, from the gross profit to the net profit, is because if you understate your closing stock figure, you also then end up understating your profit. But if this happens year on year, it means that you end up overstating profit sequentially year on year as well. So this could be a really big concern, and there's a significant amount of due diligence that needs to go in to verify and effectively recast the entire set of financials if my assumption here is correct. So that's the first really big issue, is are the numbers actually reliable? The second big issue that this presents is around the value of the inventory, because this is going to create a really large distance between what a buyer is prepared to pay and what the vendor is prepared to sell for. And let's figure this out and see if there's a way that a deal structure can solve this problem. So if I look at the current stock turn rate of 2.1, according to the value of the inventory and the revenue of the business, the first thing I want to look at is what is the industry standard stock turn rate? So the industry standard stock turn rate for an auto marine retailer is close to 5 times, meaning they're turning their stock over 5 times per year. And this makes it a little bit closer to the actual stock carry that they had on hand, the closing stock figure at 30th of June. So according to the industry stock turn rate, and this isn't absolutely bulletproof, but it's just a rule of thumb that you can use to benchmark, but this stock on hand shouldn't be any greater than 2.7 million. So that tells us there's an extra $3.7 million of stock on hand. So that's really concerning, because the vendor is obviously going to want to get paid for this, and the buyer doesn't want to include this as the total cost of capital to buy into this business, because otherwise the return on investment just gets really, really low. So how can we look at this in a deal structure that actually makes sense for both parties? There's one assumption here that we're relying on, which is a 3.78 times capitalized multiple rate. I won't go into how we've calculated that, but that's a fairly balanced way of calculating the capitalized multiple rate based on the size of the underlying profit in the business. So that basically means that the total value of the business with all of the assets, including stock, capitalized in will indicate that the fair market value of the business is $6.8 million. So that's what I'd be prepared to pay, including the stock, to get the return that the business provides, which is $1.8 million per year. What are we going to do with this excess $3.7 million of stock? And here's what probably the seller rather is wanting. They probably want $10.5 million for all of the assets. If we look at it from the seller's perspective, they're wanting $10.5 million, but to the buyer, that represents a return on investment of 17.6%. That's too low for any buyer to want to agree to. If we remove the excess stock on hand and agree that we are only paying the seller the $2.7 million worth of stock according to the industry standard stock turn, then this becomes a lot more of a viable investment at a return on investment pre-tax of 27.1%. So how do we deal with this extra $3.7 million? Well, what we do in these sort of situations is we want the seller to ultimately receive the cost value of the stock, but we also don't want the buyer to have to pay this upfront as a capital expense. It's just too capital intensive. So we would set up a side deed, which would be a consignment agreement, and that obligates the buyer of the business to then buy the excess stock as it is needed according to the industry stock turn over a period of time. Now, this might be over the next 6 to 9 or maybe 12 months. The buyer is obligated to buy this stock as it needs it from the seller. And this is a way to guarantee that the seller gradually gets paid for the stock in light of the amount of excess stock that they're carrying. And it means that the buyer doesn't have to invest extra capital. They can simply use the working capital of the business after completion, i.e. the profits of the business after completion, to purchase the stock. And this shouldn't be offsetting their gross profit or net profit. The other thing that has to be considered here is there any dead or slow moving or unsaleable stock that's included in this total stock figure of excess stock of $3.7 million? That could be something that really becomes unstuck during negotiations. And I would hope that the seller has had some advice here to create a definition of what constitutes saleable stock. Okay, so would I buy this business at the price the seller wants of $10.5 million? Absolutely not. Would I consider buying the business at $6.8 million with a side deed in relation to the excess stock? With the level of consistency in the gross profit the business has performed in the last 5 years, absolutely I would. This is a very, very, very strong business. However, I would absolutely need to pull apart the stock take of the last 5 years, the purchase history of the last 5 years, to ensure that the closing stock figures represented in each financial year of the last 5 years are reliable. Otherwise, there will be significant material variance to the actual true underlying profit of the business. So this will be a costly due diligence exercise. And as the buyer, I would absolutely require an exclusive due diligence window to properly perform the due diligence on this business without any threat of the vendor selling the business to any other buyer.